Understanding positive correlation, a comprehensive overview. Positive correlation is a fundamental concept that frequently appears in statistics, finance, and various fields of research. This article sheds light on the concept of positive correlation, its implications, and how it can be measured in different contexts. What is positive correlation? A positive correlation refers to a relationship between two variables where they move in the same direction. More specifically, when one variable increases, the other tends to increase as well. Conversely, when one variable decreases, the other tends to decrease. Such a relationship suggests that the two variables are influenced by similar external forces or factors, thereby demonstrating a dependency between them. Key characteristics of positive correlation. In tandem movement, both variables change in the same direction. Both may rise or fall relative to each other. The correlation coefficient, which quantifies this relationship, ranges from 0, no correlation, to +1, perfect positive correlation. Understanding positive correlation in detail. A perfectly positive correlation means that 100% of the time, the variables in question move together by the exact same percentage and direction. For example, consider the relationship between demand and price in a market where supply remains constant. As demand for a product increases, the price typically rises, demonstrating a positive correlation. Furthermore, correlations can also be seen across various markets. For instance, if fuel prices rise, it might lead to an increase in airline ticket prices due to the higher operational costs for airlines that rely on fuel. This connection between variables illustrates how their relationship can have practical real-world implications. Causation and correlation. It's essential to note that a positive correlation does not imply causation. Two variables might move together without one necessarily influencing the other. For instance, an increase in ice cream sales could correlate with an increase in drowning incidents in summer months, but it would be erroneous to conclude that ice cream consumption causes drowning. Both may be influenced by the external variable of warm weather. Measuring positive correlation. In statistical analysis, positive correlation is measured using the correlation coefficient. A correlation coefficient of +1.0 indicates a perfect positive correlation. A coefficient of 0 indicates no correlation. A correlation of -1.0 indicates a perfect negative correlation. Scatterplots are a useful graphical representation for visualizing the relationship between two variables. In a scatterplot exhibiting positive correlation, there will be an upward trend where, as one variable increases, the other also increases. P-value in correlation analysis. The p-value is another critical measurement in correlation analysis. It determines the statistical significance of the results. A smaller p-value, typically less than 0.05, indicates a stronger likelihood that the relationship observed between the two variables is not due to chance. Applications of positive correlation in finance. Market behavior. In the field of finance, understanding positive correlation is crucial for investors who analyze how stocks move relative to one another and against broader market benchmarks, such as the S&P 500. Beta is a prominent measure of an asset's correlation with the overall market. Beta of 1.0 indicates the stock moves with the market. Beta greater than 1.0 suggests increased volatility compared to the market. Beta less than 1.0 signifies less volatility than the market. For example, utility stocks, which provide steady dividends and are less impacted by market fluctuations, typically have lower beta values, indicating lower correlation with higher volatility stock sectors like technology. Diversification strategy. Investors typically aim to diversify their portfolios to lessen risk. Holding assets with widely positive correlations can increase the portfolio's overall risk. For optimal diversification, it is recommended to select assets that demonstrate low or negative correlation to protect against market swings. Examples of positive correlation. Here are a few scenarios to illustrate positive correlation. Employment and inflation. Higher employment rates often lead to increased wages, resulting in upward pressure on prices, contributing to inflation. Marketing spend and sales increase. Companies that invest more in marketing typically experience a rise in customer purchases. Positive correlation versus negative correlation. While positive correlation indicates that two variables move together, negative correlation, or inverse correlation, describes a relationship whereas one variable increases, the other decreases. For instance, there is often a negative correlation between the price of oil and consumer demand for air travel. As fuel prices rise, fewer people may fly due to increased ticket prices. Conclusion. Positive correlation is a powerful tool in both statistical analysis and practical applications, including finance, economics, and beyond. Understanding how two variables interact can inform decisions ranging from personal investments to business strategies. However, it is crucial to remember that correlation does not imply causation, and deeper analysis is often necessary to draw meaningful conclusions.